Happy to have this wonderful panel here. I'm going to see if I can also work the clicker. There's the food reference. Sorry, Slicing the American Pie. I forgot the title of our own presentation. So we're going to talk about the income tax aspects of whether everything is apportionable. But before I do that, I want to introduce the panel. And I'm going to start with Jess Morgan. For those that are frequent attendees, this is Jess's third year on the panel, so I think maybe we'll do like the SNL 5-timer jacket. So if you keep coming back, you're 60% of the way there. So Jess is a senior manager in national tax at EY. Thanks for joining us. I'm doing this without my glasses, so I know what Rob looks like, and I've got it. Rob is senior director at Corteva, formerly of DuPont, formerly a colleague of mine, and wonderful to have you and your corporate perspective. I'm going to sit down. And Todd Faciana from the Pennsylvania Office of Attorney General. So we will get started.
Also a 3-timer.
Oh, I stand corrected. So Rob, you're the newbie here.
Yes, sounds like that's right.
Awesome.
Although I'm an alumni, so I'm kind of back.
Welcome back. So I've got papers. This is a lot easier when other people are presenting and I just walk around with the microphone. So you'll notice everybody else at some point during the presentation, usually when they were about to say something they were cautious about, gave the verbal disclaimer. We've got the disclaimer, applies to all four of us. We crafted this in a way that covers everybody. So whether it's your corporate, your firm, or your government employee, I'll leave this up here for a second so you can read that, and we're all covered. So we've covered the panelists. I could have read that without my glasses. Shame on me. So today we're going to talk about, and the panelists primarily are going to talk about considerations on whether income is apportionable and what constitutes fair apportionment. That should be easy, right? So I have fair in quotes. I think we're going to use a lot of air quotes as we go through this. Hopefully we'll have the same level of candor and participation that we've had on the other presentations. So if there's questions, flag me down and I'll share the microphone. We'll be happy to take questions either throughout if you've got a burning question, or hopefully we've got this paced so that there's a few minutes at the end for questions and then we can get everybody off to lunch. So if we start, here's the overview. Our slides are going to be pretty simple. We want to facilitate the discussion, and we're going to talk about apportionment, really what the alternatives may be to apportionment, and then how we determine what is fair and the best way to approach that. I think the best way to approach things is a history lesson. Professor Pomp gave us a pretty detailed one this morning, but I don't think that preempts Jess from walking us through some of the history and the context specifically around apportionable versus allocable income.
That left us with a perfect place to start this discussion. And I'll start that by clarifying, what do we mean? What are we really asking when we ask the question, is all income apportionable? I'm going to lose the audience, then I'm going to try to win you back. There's a sense in which a reasonable person might say, of course, income that is earned by a business is apportionable. I think the question that we're really asking is, what income is apportionable where? And so if you are engaged in a multi-jurisdictional business, you might have aspects of your income that are related to a discrete business enterprise that is not connected with the portion of your business enterprise that is being conducted in a state at hand. That's an example of income that in this context would arguably be not apportionable. We, of course, have concepts of allocable income. So maybe as a business, whether it's comprised of multiple legal entities or even just one legal entity, an aspect of my business enterprise might be, again, wholly unrelated to my multi-jurisdictional activity in a particular state. I might have a component of activity that's wholly assignable and restricted to a different state. Well, let's call that allocable income. And then I think where a lot of the confusion and history lesson is going to pick up is there are portions of income of a business that are not apportionable business income because of state statutory schemes, things that sit above or are more restrictive than what the Constitution might permit a state to tax. And then, of course, everybody's favorite is going to be back in the spotlight this summer with House Resolution 1. But we, of course, have income that is not apportionable anywhere, potentially, in the case of federal preemption of state taxation, 86272, for example. So other than that, income of a business can be taxable, is taxable somewhere, but where and when? And I think we have a tremendous amount of jurisprudence that describes when that is. That is when the income of a multi-jurisdictional business is connected with a single economic unit, the unitary business principle. And this is where the history lesson sort of picks back up. Professor Pomp referenced the Uniform Division for Income Tax Purposes Act, UDIPPA. Might say UDIPTA. It's kind of the way I say sherbet instead of sherbet. We all know it's the other way around, but nobody cares. UDIPTA offered us this language prior to a lot of the more significant cases around the unitary business principle, and that language was business income and non-business income. And I think that language was really confusing or bleeds into how we think of state income taxation today, because it suggests that there is income of a business that is not business income. We've tried to filter other concepts into non-business income, investment income, and then we have, as arose this morning, questions about businesses whose entire enterprise is geared toward, investment and non-operational type activities. So I think there's, I think of the T.S. Eliot verse, last year's words belong to last year's language. We've built a cage for ourselves with words that had different meanings when they were enacted into various statutes for the states that adopted UDIPPA. And we're sort of still expecting that there's these pockets of so-called non-business income. And like I said, there very much are pockets of non-business income. It's the states that say that they exist, and that's in their statutes, and they've chosen not to modernize those statutes to address some of the jurisprudence that occurred 20 years after those laws were enacted, but maybe 50 years back from today.
So what role does the unitary nature of the business play? I mean, it was referenced earlier. I mean, unitary filing is an apportionment methodology, so it very much belongs in this discussion. But I'd like your thoughts on, where unity or multiformity or whatever words we want to use, where do they fit in?
The unitary business principle is the whole game, right? It's defining what the unit is. And that's where I think that there's a lot of hope and opportunity. I'll probably try to come back to this comment later in the panel. The U.S. Supreme Court has essentially said, we're going to leave to the state courts determinations of what it constitutes a unitary business, the kind of fact-finding exercises, absent some sort of extreme or unfair result. So, it's probably been, as a practitioner, a good 10 years since I've been engaged to study the existence of unitary business and document it in a 100-page binder. We had binders, like physical binders, back the last time I did this, where you're trying to build a case. That's a frontier. I think that there's a lot of pockets, questions to be asked, including around some of the concepts on the slide, investment income. If you're investing through pass-through entities, there are questions to be asked around whether entity or aggregate theory should apply. Am I viewed as conducting the business that my pass-through entity that I own is actually conducting? How does that map to tax-based building? Or am I viewed merely as having an interest, whether active or passive, in an entity that conducts its own unitary business? So I think that crafting better arguments and trying to understand what is unitary is where we're going to see more activity in determining that there is non-apportionable income because it's associated with a different unitary business.
And I think, Drew, I totally agree, Jess, by the way. But our view of like actually, practicing through that, we had in my DuPont days, which is now a subsidiary of ours, but not to the new DuPont with our good friend Jeff there. But in any case, we've had a run at this a lot, and I think taking a step back of first of all, is non-business income, does it still exist? Absolutely, it still exists. And again, think about your question of where does the unitary concept play? It's, of course, the linchpin of apportionability, right? Back to
You wrote
mobile.
that?
That is a very fact-specific, very tough thing to do and to prove out non-business, because the bias is certainly that, it's part of your business, it's something that you did, and therefore should be apportionable. But I think to the other finer point of why does it matter to a state, it's that they can't get at it, or it's all theirs. So think about that, right? If it's non-business, non-unitary, and it happens to be beneficial to them because it's situs there, that's theirs. But if it's not, if it's just apportionable, they can't have it, right? So I think that's an important distinction of like, how does it become real, right?
That's where I think that there's sort of a challenge. If I look at the states that still have the statutory schemes that have, let's say, per se non-business or per se allocable income streams, sort of some of the Southwest, right? The Oklahomas,
like
Arkansas, Delaware, Mississippi. I'm trying to think of who would be the champion to have a modernization. There's sort of an inertia around types of corporate income tax schemes that I don't think there's a particular grouping of taxpayers that are going to say, we demand that the statutes reflect the U.S. constitutional standard for apportionability. Instead, it's going to be if I'm in state and I'm being allocated all of my interest expense deductions, or if I'm out of state and I get to allocate away my dividend income or capital gains. There's winners and losers in each of these circumstances. It almost seems like the impetus for legislation, for modernization of some of these statutes would need to come from within the taxing authority or legal division and saying, look, we understand if there was to be a significant challenge around our statutes held to the fires of the U.S. Supreme Court cases of years past, we'd lose. That's a lot of uncertainty. It seems like that's the only path forward, because it's hard to find a group of taxpayers that say, tax me more or tax me less.
Well, and is there really an opportunity for legislation to provide clarity? I don't mean this in the broadest sense that I just said that, but we've talked about how fact specific this is. There could be modernization in terms of how non-business income or allocable income is treated in the states, but even the more modern states, there's so much uncertainty. That's why we're here, right? I mean, is there a means, have you seen an example where the states have provided clarity? Or Todd, jump in if you think the states are clear. Maybe we're already there. We just don't.
I mean, I was thinking about this question and whether or not it would be better to have clear statutory law regarding what is apportionable, non-apportionable, et cetera, whatever that is, versus having more of a facts and circumstances standard. And I think looking back at the history of the case law and thinking about those states that have adopted the U.S. constitutional standard for apportionable income, it's rather clear when it's apportionable and when it's non-apportionable. And it seems like there's a clear set of facts or a clear set of criteria that you look at. And I think, a lot of the struggle, is meeting out those facts or, objectively looking at those facts in relation to the state, the activity in the state to draw either those tenuous connections or, those closer connections if you want it to be apportionable.
Okay.
And I get that's
So,
not popular opinion.
And when I think about that is relatively clear.
Yeah.
Taking a step back, I guess I would agree with that with most of what you're dealing with, right? So most of our, for example, income, Most of the apportionment questions are, okay, fairly clear. But I think what comes up is it's those ones that are, hey, it's an outlier, either for a treasury function that isn't, it's necessary for the business, so unitary, but it generates an awful lot of income or income and gross receipts. And the question is, well, where does that get spread? Is it it's not non-business because it's part of your business, but then how do we allocate that? Or how do we apportion that? And that we can get into for sure. But also you see it in transactions. So you see it where you've got, a significant transaction that generates potentially a large amount of gain or potentially loss. And then you've got the questions of, okay, if it's not, if it was like a joint venture, then you start to get into the questions of business, non-business. What are the facts around it? Was it an investment? Was it part of your operations? What was the purpose? And then you get that whole other tree of like, well, where do you go? And that's where it gets pretty gray.
And I think that was kind of my point, is once you adopt a U.S. constitutional standard, I think it's pretty easy. I think the criteria are pretty clear, et cetera. It's when you begin applying concepts of business income and non-business income, which are statutory terms, is where things get convoluted, because you see a whole lot of case law trying to define those terms like functional integration and all that stuff. And then on top of that, you have some case law, adopting the and, where the and test was applied to when the or test is applied. And again, I think that's when you begin to get some convoluted results. But I think when you look at the U.S. constitutional standard, again, to me, it seems pretty clear. And case in point, looking back at some of the history of Pennsylvania's case law on the topic of non-business income, business income, apportionable income, multiformity, and unrelated assets, you can actually look back at, under the new standard of the OR test or the U.S. constitutional standard, and you could see exactly how that law would apply backwards to get different results now.
Definitely litigated the words and or an awful lot.
Yes.
In my career.
Yes.
But even if you take a step back with that, so when we talk about the constitutional test, just to be clear in my head, we're talking about operational versus an investment.
Well, I think there's under the U.S. Constitution, I think there's two analyses that need to be made. One is the business enterprise unity test, and then there's also the operational assets versus
The basic
investment
unity test, and then
Right.
operational or investment.
Right.
And again, I would pose that I'm not sure that's all that different questions than just the kind of the transactional functional test. I think you end up with, and from going through this with multiple states, when you start laying out, okay, there's only one set of facts in a particular transaction you're dealing with.
Right.
And what are the differences between, okay, it's operational versus, is this a normal part of our transactions? Well, how many transactions? And then there are a lot of parallels between those questions. So again, it may be more clear
Right.
in some of the language, but I think in practice, I'm not so sure that the litigation ends up that different.
Right. No, and I think you're right. And again, I think there are some clear examples, in Pennsylvania where you would get a different result. Like, I think Canteen Corp is an example, Laurel Pipeline is an example, and so on, where you may actually get a different result under an and or an or test because of the reinvestment of the proceeds in the business.
Before we
and so
jump
on.
off this one, I wanted to throw out the one that I thought was kind of interesting relatively recently. I'm sure others have seen it out of Arkansas, Murphy Oil, where now we're talking a lot about, okay, it's income. And a lot of these fights are, okay, well, where do I allocate or apportion income? But that Murphy Oil was interest expense related to a spin-off transaction. So in a lot of spin-off transactions, one of the parties basically leverages up to be able to equal out the capital account of the spin out, and then the spin out entity results in interest expense going forward, paying off the loan. And Arkansas went through the kind of, well, is that business or non-business expense, right? Which ended up an interesting result where the taxpayer went through and the analysis was, okay, it's it's unusual, not transactional. Functional, well, it's not unitary, not part of our normal operations. And so it gets allocated to their corporate site, their headquarters. And the state took the opposite position of like, well, no, it gets spread, right? And you can see why they would do that, right? Because they probably took a lot of interest expense impacting that state. And the court said, no, it's just like the income analysis, and you end up that it's not unitary, non-business, and that gets allocated, even though it's an expense item. So you really have to think about it also both ways, I think.
I agree, and if I'm not mistaken, what was interesting about that case is it was stipulated in the facts that this was a non-business relationship transaction, and so it's almost like the court had an inevitable conclusion to reach. It was just the tying together of the fact that business and non-business concepts apply to net income, which is gross less deductions, and as referenced this morning in regard to the New Hampshire case and part of Professor Pomp and Jeff's segment, it also applies to attributes, capital loss carrybacks, something to be on the lookout for. 163J limitation attributes are becoming more common for state purposes. I see those in the diligence environment growing in size post-TCJA. So this is where we get issues with not only trailing nexus, but making sure that we're tying together the apportionability of that business and its income and deductions the year that they were earned or incurred versus the year that they might ultimately be allowed as deductions, exclusions, and tax benefits.
I love the capital loss carryback one. It's such a nerdy kind of fact pattern. So, and there's a GE case out on this one, which is the taxpayer loss. But there are other kind of instances where, not necessarily a loss from that state, but in year whatever X, you've got a capital gain, and then you go 2-3 years out, and all of a sudden you happen to have a capital loss. So from a federal perspective, you're like, oh, I want to take that back and cover my capital gain, so capital loss carryback under the old rules. But then the question on the state side becomes, well, wait, how did you treat the capital gain from a state perspective? Was it apportioned or allocated? Was that business or non-business? And also, wait, how are you treating the other transaction, the loss transaction? Is that also allocated and apportioned? And in the GE case, it was two different ways. It was the business income, or the income one, the gain one was non-business, so allocated from a state perspective away from that state. But the loss was business and therefore apportioned. And that's an interesting question.
So this is the safest space you're ever going to find to be a tax nerd. So dig in. I'm just going to ask. We're going to take a shift here in a moment to talking about fairness. So far we've talked about what the statute says, what the facts and circumstances are. Anything else anybody wants to add on the industries, the investment income before we move on to this simple question of what's fair? Well, there's the question, right? It's a little bit loaded, but when is apportionment fair? And I mean, I think a lot of callbacks to Professor Pomp and his commentary about the movement to single factor and other things. But I mean, the idea is it's supposed to fairly reflect the activities in the state. There's a formulary way to get there, and we heard the debate over does the formulary apportionment get us to a fair result. There was some allusion to UDITPA Section 18 and alternative apportionment. But I guess let's start by talking about, and Rob, maybe you want to take this one a little bit. I mean, the test to show what is fair or not, I mean, it's probably something other than I'm getting to the tax result I want, right? There's something broader.
Yeah, so I think in a different context in kind of negotiation generally, I think I learned at some point that the worst word you can use is fair. So yeah, because nobody really understands, it's what's fair to you versus what's fair to the other party, and there's a lot of disagreement. But yeah, the apportionment is as has been developed, in case law, it's a rough approximation, related to the item of income and how that's generated relation to the state, right? So that's the Mormon, the container concepts in there. Easy to say and difficult to apply, right? So when we look at Pennsylvania is an especially interesting one, Todd, with the concept of multiformity. And I'm not sure do other states have multiformity? I don't think I've ever seen it. I think it's
The Constitution has multiformity.
Does it?
so-
Okay.
Yeah,
I
so I
didn't
mean,
even know that.
it's a term I think probably primarily or largely unique to Pennsylvania, but yeah, I think it's the term used to describe a non-unitary business.
So kind of like
And then in Pennsylvania, I think it's more specifically applied in a separate entity concept. So you're not looking at separate entities, you're looking at separate divisions or separate business ventures that are within the same entity.
Right. So when you think about things like that, which I also kind of think through as okay, what are the benchmarks of what's fair? So maybe on one end, if you had the ability to get kind of that separate accounting answer, so what is my connect to the state? What this business unit developed that particular income, and kind of all the way to the other end, another historic DuPont case that way before me, but it was the main case. So and so developing the Augusta formula and kind of the concept of if it was, a worldwide apportionment, and that could be the maximum, and what would that look like? That would be your maximum amount that the state could pick. So somewhere in between of total separate separate accounting to, what would be your share of worldwide kind of apportionment lies kind of the fair, right?
What's interesting, that's where we get tied up in words again, too. Outside of this kind of environment, when you hear the word unitary, most people are probably meaning to refer to the combined reporting method for multiple corporations that comprise a unitary business. And so we're faced with states that have statutorily adopted separate company reporting, even though that company may be earning its income as a part of a broader enterprise connected with other affiliates. And I think, the combined reporting method is itself an apportionment method. It's a mechanism that was adopted, first by California. It wasn't statutory. It was the state taxing authority that used combination as a method to create as its base, to create as the pie that it's slicing up all of the total net profits of this economic unit. And we've seen other states that adopted combined reporting as an apportionment method administratively as well. Look at Kansas. There is no statute that says that Kansas is mandatory unitary combined. It's an interpretation. It's a method. Some states have tried that and been unsuccessful. I think the South Carolina Department of Revenue, of course, had some of the more interesting litigation where combination was used as a technique. I've sat on panels with other southeastern states that said that they're using transfer pricing concepts, things that are maybe more akin to a separate reporting style thought process because they feel that they don't have the authority to invoke combination as a method. But if we're thinking about fairness, I don't have to come up or conjure my own ideas of fair to the extent that I can rely on a complete auto and point to the fact that my apportioned tax should have some meaningful relationship between the benefits conferred by the state onto my business. And maybe this ties back to and lays bare the challenges with the one-legged stool, the single sales factor. If I'm moved into a so-called forced combination is a method of apportionment, and I have a single sales factor with market-based sourcing, let's say I'm a consumer-facing entity, combination, as long as I'm earning profits, is only ever going to increase my taxes paid to the state. Have my benefits received by the state relative to my tax burden been understated this whole time? Are they overstated after combination? If my value drivers that are earning me profits in legal entities that are outside of this state are related to R&D investment activities, management of an IP portfolio, these big value drivers, I get no representation of those value driving activities, just the value, just the profits. coming in under a combination method. So stepping back, apportionment and combination as an apportionment method should be held to the fire of whatever we think is a fair reflection of the benefits and services provided by a state. That's one of the yardsticks that we can be using.
So we've talked about the group and the unitary concept, and Eileen, we'll get you a microphone in a second. We've got them all hoarded up here. But there's always been a question of matching the tax base with the apportionment. And I feel like this issue is on steroids now after TCJA, just because of the federal changes and what's running through the tax base. I mean, and what I'm seeing, that's been one of the most prevalent issues. So I wanted to move to that question, but now we did get Eileen a microphone. So before we move off topic,
Okay.
go ahead.
So I'm curious, how do you measure the benefits that a business receives from the state?
It's a great question. So I don't know. And as a matter of fact, I have, by the way, I have no answers. I just have kind of our opinion, my opinion, by the way. And
read the
and some
disclaimer
experience, right? So how in our own approaches of negotiation over kind of litigating this issue, we've looked at things like, okay, what's our presence? How many people, right? Those are easy, right? What kind of fire protection, police protection? Like if you have physical presence there, that gets easier. The harder one is like, wait a minute, I don't have anything with salespeople that show up there occasionally, but then you go to, well, it's the market, right? You've produced a market. I have recourse if I sell something to somebody in your state, and I can utilize the court system. So you start with like, okay, the easy, right? And you go down like, here's my presence, here's my people, here's the activities, all the way down to, okay, well, wait, it's just the market, right? So yeah, it's a tough one. And I think we've also kind of tried to measure that the same way of like, again, the separate accounting concept. Well, can I tie my business that we're dealing with to a specific activity in that jurisdiction? A lot of times it can't, right? So then that goes to, whatever your facts are. To me, it was part of negotiation of like, okay, well, you don't like the way we've apportioned it. I don't like the way you've wanted to apportion it, but here's our balancing out of what we think our presence is and what we're owed.
Right, and I think you do that through, an alternative apportionment factor. I mean, I think that's the way you do it, right? I mean, you have to find a reasonable alternative, and you have to qualitatively, justify that use of that formula to apply it to the apportionable income, and then you make that comparison between the statutory formula, the reasonable alternative, to arrive at whether or not there's a disproportionate amount of, distortion.
And I think also as part of that, you'll end up, if you really go forward, you're going to get an economic expert to do a study, things like that. But
To that point, I think one of the things that economic and maybe government policy expert would be looking at is we have publicly available state and usually local government expenditure reports, right? We could see on a line-by-line basis where appropriations were made, what is the spending that's being done on an annual basis. And so being able to tie, and admittedly some states offer that information at a more detailed or maybe even accurate, updated level than others, depending on how they procure their legislative services. But there are, very methodical ways to identify what services are being provided by a state or local government. And so I think that's the starting point for saying, all right, I'm stacking up against this level of fairness. I'm going to have some kind of documentation of what I may or may not reasonably be accessing in terms of those benefits if I'm only present through delivery to in-state customers, or if I'm only present via a sales office or some of these more limited footprint fact patterns.
You asked a question, so you get four responses. You get to pick which one. I'm going to offer my opinion here that I think there's a degree of relativism. So I agree with everything that was said, but it's, as Rob said, it's really hard to measure the benefits you receive. But what are the benefits relative to another state? So, I mean, you know, I mean, the Smithfield case was mentioned, but you know, I know they do a lot in Virginia, and they're getting taxed in California because of the formula. If they're being taxed the same in California as they are in Virginia, you know, I would argue that, you know, there's no way that California is providing the same benefit because they don't have the people, they don't have those types of protections. So I don't know if I've seen that argued. I mean, it sort of gets into external consistency, but you're like a layer deeper into this. But I think maybe it's the, you know, sidestepping the question, but, you know, it's, you know, how much is one state providing in terms of benefits relative to the other? And then ultimately, I think that it gets you back to fair or alternative apportionment argument.
Yeah, and that concept, like a lot of auditors will say, hey, I want to see your 50 state, you know, apportionment, right? Or you'll get asked, well, how did you treat this particular item of income in your home state or this state or whatever? Several cases have said that it doesn't matter, right? What's going on in the other state doesn't matter. The real question is how that state, whatever state you're dealing with now, and their law treats it. Because at the end of the day, I'm not even sure how you answer that question of like, okay, well, I'm going to give you 50 states. Do I do it the same way that all of your state, you know, rules would apply to other states? Do I give it to you in way, you know, based on the other states' rules, right? So that's why it kind of, I think, comes down to the question of, I'm not sure that matters.
I don't think it matters, but it can, I think, serve as a guidepost in terms of whether or not, you know, the taxpayer is, you know, apportioning it correctly or consistently. You know, it goes back to the, you know, discussion was earlier. I mean, you know, seeing something applied on a consistent basis, I think gives the government a certain level of comfort that you're doing things, you know, correctly, above board, or in good faith.
Yeah, for sure. And the only one I would push back on that one is just think of the theoretical scenario where, you know, an item of income is apportioned in state A, but it's allocated in state B, allocated away. So, and the taxpayer is following both rules, but you're ending up with basically disparate answers. And is that going to be looked at as consistent?
No, I mean, you know, again, I think, you know, if I were to make that, you know, use that as a guidepost or use that as a basis of, you know, comparison, I would look at how are you sourcing that in those states that have laws very similar to Pennsylvania? And if there are, you know, distinctions like you were noting, you know, are those valid ones? But then to your point, I think in that case, it doesn't really matter that much. It's really about, I think, whether, you know, again, it's a guidepost. It's a way to see if, you know, a taxpayer is doing things above board on a consistent basis. And if they're sourcing sales to other states that have similar laws as Pennsylvania in the same manner, I think that's an indication of, you know, are they just taking, you know, a position in the state? Do I need to look at it closer? Or, you know, again, it's just a guidepost. It's a litmus
Am I cherry
test.
picking or am I consistent with consistent rules?
Exactly.
Internal consistency.
Exactly.
So Jeff,
I made
you
that
have-
up.
Jeff, do you have a question or a follow-up to that?
Yeah, just a kind of general comment. I think I was brought up at the first session also is when they went to single factor all over, fairness got thrown away. Okay, that's not even an issue anymore. So right now, if you go back into history, I've been around doing this for a few years now. Them taking away the three-factor, and we talked about alternative apportionment. It's so hard to get to that standard in most courts. They want you to, you know, come up with a percentage that they're dreaming up that's almost impossible to get to. But I really think going back, we were able years ago to use a fourth factor. So if you have royalties, if you have dividends that are subject to tax, you come up with a fourth factor to make it fairer, not perfect, but fairer. And I think that's probably when the legislator got in and looked at it from, oh, I'm protecting my neighbor, my next door neighbor here, instead of taxing everyone together. I really think that shifted the paradigm for everyone to understand this isn't about fairness, this is about revenue. So I really think you've got to look at the, you know, going back to some of at least a three-factor, if not even a fourth factor or something else to pick up the income, like the GILTI income you were talking about earlier, Rob, or whatever, you know, just the different things that are being taxed by the states.
Well, thanks for that that segue, and I'm just going to point because we are going to move along and we can address that as well. But the factor representation question, so you mentioned guilty at the end, and there's litigation popping up now in a number of states on that. But thoughts on, can you really have a fair representation if you've got a significant discrepancy between what's in the tax base and what's in the apportionment? Maybe I'm leading the witness a bit, but can it really be fair if it's in the base and not in the apportionment?
I'm not going to answer your question. So I'm going to go.
It was your question.
Yeah, I know. So I think the one, before we leave the other topic, the one cool thing I wanted to, again, go back to that other answer of that Vidian case in Michigan is actually between cities, but talk about another impact of like, okay, well, what's my connect to the state? That one was all about a remote employee that happened to be outside of the city the city that they were dealing with. So they were facing 100% apportionment, and they were looking for the right to apportion, which we didn't touch on, right? But just that little connect of somebody working at home that's not 86272 protected gave you the right. So that I thought that was cool. So just like use that in as you will. And then to your other question of, okay, can it actually be fair? I guess, I had the good fortune of working with Paul Frankel for many years, as many of you others did, and he beat into my head, if it's not in the base, or if it's in the base, it should be in the apportionment factor. And there's really good precedent for that, but that's like a touchstone, right? So to Jeff's point, guilty is like a biggie, right? Where we've seen it in a couple of the cases already, and why aren't we getting the guilty is essentially the income of your CFCs. No question of unity in most cases, so you're more than 50%, and it's just like you make a sale in the U.S. and that gets picked up in your current income. For us, for example, make a sale to a customer in Brazil, that gets picked up in our federal base as well. Now, there's some, portion of it, but it's essentially the same transaction. So why aren't we getting the same apportionment, representation, right? I think it's a good question.
I agree. And we have like a paradigm for this. There's a handful of states that, if you think kind of pre-guilty, just classic, regular foreign actual distributions, right? Why don't we just pull out and have two different components to our apportionable tax base? And we have the domestic base that uses domestic factors of profitability, which can probably just be single sales, as we're seeing. And then we have the foreign taxable income, also from unitary sources, but that treats similarly the foreign portion of the business that generated the earnings that were ultimately included as net income, just as the domestic base was. We've got New Hampshire and these kind of New England states with the special dividend apportionment rules. Is that so hard? Can we just do that more?
I don't think that's a bad answer. I think Pennsylvania's capital stock franchise tax is an example of that, where you had a mismatch between the apportionment formula and the tax base. And you could, I think, make the argument, in my private practice days, I did make the argument, that, by, including, the proper factor representation in there, you can get to a distortive result and, support a case for alternative apportionment.
Mm-hmm.
And so I think I want to also make the example, and I'm not going to talk about our case too much that's currently at the Minnesota Supreme Court, but, same kind of concept. It's not foreign income, but where I touched on before, it's the kind of treasury function income. And it generates either gain or loss, so no question. It's in the base, no question. Business income, no question that per the statutory formula, it should have been in the sales factor. And gross means gross. But then you get into that next question of distortion. Yeah, you're following all the rules, but should you have brought up alternative apportionment? Or whose burden is it to bring up the alternative apportionment? And what do they need to sustain that? I think that's where, if you go through all those kind of questions, now you're getting back down to that distortion. And that's another sticky argument. How much distortion is too much? What's permissible? What's impermissible? This is all a guess anyway, right?
That brings us, to, what's fair? So, I mean, assuming that's the objective, and I think, that's the spirit of this forum. We're trying to have an open dialogue, and we hope that everybody here is trying to get to a fair result. They may view it differently, but if that's the objective, what does fair look like?
It's like that thing, you're a kid on the playground and you kind of look up at the sun because your mom told you not to. And you see on the corners of your eyes all those eye bugs squiggling around. And then you try to look right at them and you can't see them anymore. They're gone. That's fair.
It's
It's better than the pornography analogy.
It's so much better than the pornography reference. Thank you. But I mean, really, I guess I didn't think I could get anybody to bite on a question that nebulous, but I appreciate that. But I mean, what more specifically, what are we looking for when we're measuring fairness? I mean, so it's a concept. We want it to be fair, but we're into measuring things. So how do we measure fairness? We've talked about relative to the benefits provided by the state, but what thoughts on other measures?
I think there are concepts that exist in multi-state taxation that lend themselves to fairness or evolved out of cries for better, more fairness. Things like uniformity. MTC uniformity projects have addressed a variety of the topics that we've been discussing today. I think one of the challenges to uniformity, and we've talked about the states where we have the uncertainty, or statutory schemes that sit above or look differently or read differently than the U.S. constitutional schemes. Justice Brandeis had the line that the states are laboratories of democracy, and when I see language that talks about non-business sources of income, it reminds me of like a petri dish where we're still like cultivating ancient bacteria that's contaminating our discussions on how multi-state income taxation should work, and what is the
great pre-lunch discussion.
Great.
So I think, that's uniformity. And then I'd say also like an environment, I know what it would look like, right? I don't think what helps at all is an environment where we can sort of pessimistically say, well, there's uncertainty, but I know that the state's answer is going to be whatever results in the most tax, and the taxpayer's answer is going to be whatever results in no tax or the least tax. I don't think that there's, that fairness enters into that equation at all. So I think a system that's well understood, and again, maybe even has features of uniformity, lends itself more to fairness in that light.
And I think, it may refine down to, you can't define fair for absolutely everyone for everything. You've got to look at your whether you're a client, you're working for your company or whatever, you've got to really refine those and develop those facts for what is fair to you in your business, your activities, your facts, because they would be inherently different than somebody else down with a different presence profile, business, income profile, or different activities that they've got going on in the state. So I think these are rules and concepts, but I think it's a kind of maybe a misnomer to say there is one fair, right? Because I think it's fair as applied.
Right. I think that's 100% right. I mean, to your point, I mean, the statutory formula won't fit every situation, and in most cases, it'll fit a lot of them, but then it's incumbent upon, the taxpayer to have that dialogue with the state in terms of, if this is not fair, then tell me why. I could just, see reading a taxpayer's proposal letter right now, and they, the first word that comes out the page is, this isn't fair. And then my next question would be, why? And then we can have that dialogue, and as long as there's an honest, candid dialogue, about why you think it's not fair, and we can look at it in an objective way, I think we can get to the right result. It's to, Jess's point that I think when parties try and defend, the dollar too much without looking at, what is the right answer is when you get skewed results.
I think that's true of both sides.
Yeah, no, I think I know, and I think honestly, I mean, it takes collaboration. I mean, from the state's perspective, we don't have all the facts. We don't know, what's in your mind or why you think things are what they are, why you think they are. You need to show us, and once you show us, then we can evaluate it. But again, there's systems in place, and that's the way they work, and you need to show us why the alternative would apply.
Oh, I think the only other point I was going to make there is when you get down to that level of, okay, well, we've agreed on all the business, non-business, et cetera, and okay, now we're trying to figure out alternative apportionment, or is it distortive or impermissible or whatever. There's not a lot of solid guidance actually on that. We've got the case laws of bookends of like Hans Rees and others where it's like a 14%
Out of all
150.
proportion, that's the
right.
standard.
So somewhere between 14% and 150% of apportionment lies the truth. Well, maybe we've got to keep developing and hopefully get a little bit more guidance on distortion. I'm not sure.
So I'm keeping an eye on the clock, and I hear in my stomach. Maybe somebody else is. If there's questions and I'm missing somebody, please raise your hand. Joe Bright with a question. I'm already deferring this to somebody else.
I'm deferring to Drew.
Thank you. This is not a question, but hopefully a useful observation. The underlying problem that we're wrestling with, both at this panel and the one previously, is that we are trying to physically locate a number with physical things. Net income is not a thing. If you go to your finance director and say, go out with your wheelbarrow and bring back full of net income, you will not get a helpful response. But you can locate physical property, and an event, more or less, can be located. What you pay people, payroll, that can be located, more or less. Sales can be more or less, it's transactional. And as you get into it, and as you get into services, it gets into more, less than more, because it gets very difficult to locate it. But at least it is something that's concrete, and the net income is never concrete. So the answer to the first question is all net income apportionable? Is yes. And the explanation is, it's got to be, because if it isn't apportionable, they can't tax it. So that has to be the case. And what is fair reminds me a little bit of the mathematical problem reported to me by my mathematical friends of squaring the circle. How do you express the area of a circle in terms of a rectangle? The Greeks failed, Leonardo failed, Descartes failed, Newton failed, and my mathematical friends tell me it remains unsolved. You can't do it. So what is fair? The answer there is, quien sabe? Who knows? It's a judgment call, and it's roughly analogous to the definition of pornography. When you say it. And it's very much a judgment call, and it depends on those constituent elements of the things that compose net income or influence net income. And there is no simple solution to that. And it requires a careful examination of what's going on and who's doing it and what the results are. End of observation.
Yeah.
I love that observation, and I think the key word that stands out to me too is judgment. There's going to be a judgment in the case of if you think something is unfair, petition for alternative apportionment. Actually, that gives me a chance to, in honor of Mike Sims, the very first time I got to work with Mike while he was at UI, I was helping him prepare for a moot court. Actually, Steve Vladichek, I think that you were a part of this at our annual meeting. And this was 10 years ago, so this would have been right when we started seeing a lot of excitement around alternative apportionment. And Mike's closing argument in his typical sort of like, fervor and excitement and colorful language was alternative apportionment is the new black. And so just the idea of, that kind of prescient observation that what we were about to go through for the next decade was taxpayers looking at sourcing rules, apportionability rules, largely written in decades prior, trying to measure increasingly intangible sources of income, which is itself intangible. So significant gains from sales of stock of corporate subsidiaries or investments that are greatly in excess of what gross receipts from the regular business are. These kinds of fact patterns. So I really appreciate your comments, your observations, and I think that this gets back to kind of the modernization ideas. Is the fairer reflection is going to be the one that more closely understands modern sources of income that use the digital economy as a component of that measurement.
And I appreciate your comments, Joe. But and I would say another thing: we're not alone in this question, right? I think the OECD struggled with Pillar 2, and even I think kind of took a look at state apportionment methodologies and was like, that's crazy, and said, they went a different way. But they also struggle with what's fair in the international context of, multi-jurisdictional business. So it's not an uncommon, unprecedented problem, but I don't think anybody's got a good final handle on it.
And I was going to ask for final comments, but I will take those last two eloquent summaries as your final comments, Todd. Anything else that you see as a key takeaway or anything we've blatantly missed in this discussion that we should cover?
No, I think we hit it all, and it was especially nice to have comments from Joe on this topic. So thank you.
And I appreciate the eloquence. I'm worried the number of references we've had to pornography that we have our theme for next year, and I'm not sure the university is going to approve. But well, so I'd like to thank the panel. I'd like to thank everybody for their patience and participation this morning, and thank you for joining us for the first half of the day. Thanks, guys, and Jess. Importantly, lunch is out where we. Oh, that.